Welcome to the first Theta Live with the topic 3 Ways to Trade Zero DTE. I am John Einar Sandland, and I guess that name is a bit complicated for non-Scandinavians, so let's just say John in English. I live in Norway and I have for many years worked as a journalist and communication manager in Scandinavia's leading media company. And then I started Theta Profits 1 year ago, and the primary objective has been to introduce other traders to various strategies and approaches to options trading. Every Sunday, a new interview with a retail options trader. Theta Live is an extension of this effort that I wanted to do for a long time. And today's topic is zero DTE, day trading options, 0 days to expiration. More than 500 people 600 people actually have registered for this event, which is quite amazing, I think. This will be a very interactive session. And most of the time will be spent on questions and answers. We'll do some live polls and use the live chat, etc. We have 3 guests, as you know, and they are invited because they have 3 things in common. Firstly, they are all well respected in the options trading community as very experienced zero DTE traders. Secondly, they all willingly share their knowledge and experience with other frienders. And thirdly, they're all very friendly, very nice people, which is good. There is also one additional criterion, and that is that they trade zero DTE in very different ways, which I think will make this a bit extra interesting for all of us. So let's bring them all in. And the first guest is Tammy Campbell, queen of zero DTE.
Good sound effects.
And our next guest, Dale Perryman, the Iron Fly guy. And finally, Mark Anderson, 0 Day Mark. All right, let's just take a very quick introduction first before we move into the program. Ladies, always first. Tammy, who are you?
Just the quick introduction is I'm an options trader. Been trading since about 2000. I've been trading options since about 2007, 2006, and trading zero DTE exclusively since 2019. And I have a presence on Facebook and a Discord group. Love options trading and love to talk about it, much to the chagrin of a lot of my friends. But so it's nice to have this forum where I can talk freely about what I do every day. And thank you, John, for putting this together. It's nice to be on here as a panelist with 2 other great traders that I really respect, Dale and Mark. So it should be a good session today.
Let's move to you, Dale.
Okay, well, I am Dale Perryman, and thanks for having me on the show again, John. I think we've had 3 other sessions that we've had together. So in terms of my introduction, I guess I bought my first mutual fund in 1988 and had to drive to the library to research it because there was no internet. I was a buy and hold forever until about 2008, and I saw the market crashing. I was playing poker in Atlantic City and was watching CNBC and watching the market tank. And I called my friend Tay, who worked for a hedge fund, and I said, "What's going on with the market?" And he said, "What are you doing to hedge?" And I said, "What's a hedge?" And so that was like 2008. And so after that, I started learning about options and started trading strangles and straddles and was a student of Tasty Trade, and I guess it was about probably 5 years ago that I discovered the Iron Flies. At first, I traded the Jim Olson version of the Iron Fly, and today I'm trading it differently. And I'll be here today to talk to you primarily about that strategy, how it works, and how it's gone.
Great. And let's move to you, Mark.
I'm Mark. I've been doing finance stuff for probably about 5 years. Got a lot more into trading options about 3 years ago, especially 0DT. And then I just kind of got obsessed with it. And then now I run a hedge fund, sell a large amount of 0DT options.
Great. And the three of you will very soon present how each of you trade 0DTE. But before that, I thought I would give some practical information about how you can interact with the panelists and others in this live stream. There are, as you know, two places you can watch this. You can watch it on the YouTube page or on the event page on Theta Profits. And both links are, if you want to switch to the other, are in the emails you have been receiving. And then you also have two ways to interact. The first is the YouTube live chat. This is for interaction between everyone watching, say hello to others, cheer on the speakers, or share your thoughts, discuss, and more. I will sometimes, as you have seen, bring messages from the YouTube chat into the live stream if I find it relevant. So don't be surprised if your message pops up. But we will not take questions from the live chat on YouTube to the panelists. So take part in the discussion there. Remember, be nice and respectful to the others so we have a good tone. And then for question, we are going to use an app called VVox. And let me just bring that information in. This is the address for the VVox, and so you can pick this up on your mobile or another device, or if you're watching on the event page on Theta Profits, you will find it in the form below. When asked about the session ID, you write 101-588-199. So it would be great if everyone can do that right now, and we will start off with a small live poll. So go to vvox.app and enter the session code 101-588-199. And in the meantime, we do appreciate that you use your full name when asking questions. It is not mandatory, though, if you're not comfortable with it. And then you do have the option to post your question as anonymous. But also then remember, only post the questions in Vivo, not on the YouTube chat. We are not. It's just too much to keep control of. And there is actually one more way you can ask questions. If you actually like to come into the studio and ask on the video, there is a link that you can actually use. I will share it a bit again later too. But I hope everyone now is connected and are already in the YouTube, in the VVox app. And in the VVox app, you will find two icons. There is a house icon, which is where we will use when we have the live ads, the live polls. And then there is this Q&A icon or a chat icon where you use to ask the questions or look at the other questions. And as you can see here, there are already many questions, and you can also then vote them up or down which questions you like and find relevant. In general, we will take the questions with the most upvotes first. Maybe not always, but do vote up the questions that you actually like and think are relevant. And of course, try to ask questions that are as relevant for as many people as possible. And again, be respectful and friendly, please. Okay, maybe we should now test this. I have to just look a bit at another screen, and here we have one question, and which single word best describe what you expect from today's Theta Live? You can answer several times, but only one word each time. So let's see if we are starting to, we will get up like a word cloud here with your responses. So I hope as many as possible of you can give your responses, so we get some kind of an idea what you are expecting today. All right. There is a lot of expectations.
Profit, knowledge.
What do you think, Tammy? Can we live up to this?
I hope so.
Your reflections, Mark?
I'm here for it, ready to answer any questions.
That's good. All right, we will. I think most people probably have responded now, and I think it is enough of me talking. So I asked each of our panelists to spend 8 minutes to present how they are trading zero DTE. As I mentioned, I have chosen them because they trade it in quite distinctly different ways, different strategies. And the first to present is Tammy. Tammy, go on and let me know when you want the slides in.
Sure. We can go ahead and get the slides up. There. So I thought, since this is about zero DTE trading, I still hear, I know there's a lot of people that are new to zero DTE trading, continually coming into the groups and trading, and I hear a lot of the same issues. So I thought I'd cover some important things first before I go into my strategy. First of all, for zero DTE trading, I would recommend an account size of $30,000 or greater to avoid the pattern day trading rules. And then one of the best things about zero DTE options is no overnight risk. So, you've got a good advantage already in just no overnight risk. Then third, always use a stop. That's my recommendation. I know Tasty Trade, a lot of us came up through Tasty Trade and learned their techniques, and they don't use stops. That I just don't recommend that when you move to zero DTE options. Market stops work best. Stop limit orders can be blown through. You can use those in certain, I used to recommend those, but CBOE has made some changes on how they handle stop limit orders. So market orders generally work best. And anyone who says they've got a mental stop has a mental problem. It just doesn't work. So use a stop. And then another thing is that's very important if you're not familiar with zero DTE is if you're using stops on spreads, be sure to remove the long leg from the stop when it becomes worth less than 5 cents, because that 5-cent option or less is not tradable. And so any stop with that leg in it won't fill ever, no matter how high your stop goes or how high the price of the option goes on that spread, it just won't fill. So you have to close the stop and then just move the stop to be on the short leg only as you get toward the end of the day. And then I highly recommend back testing. I think all of these guys have back tested that are talking today, and it's just an important part of zero DTE options. And I recommend TATS BYOB or Option Omega for back testing. They are both based on 1-minute data. And TAT is Trade Automation Toolbox. So you can go to their website. It's a free back tester. Option Omega is a back tester on steroids. It has a lot of variables, a lot of options, but it's a really good back tester. So I'm going to talk about multiple entry iron condors, and I have 8 minutes or less now, and I'm going to go through this pretty quickly. But my goal for trading options, no matter what strategy, is a good annual return and low drawdowns. I just don't like the psychological effect of high drawdowns, so I really aim for low drawdowns. And the MEIC rules that I use are legging into an iron condor multiple times a day using 0 DTE options on SPX. I enter 6 trades each day at about 30 to 60 minutes apart, generally in the late morning through afternoon. My credit targets, lately I've reduced them because of the lower volatility, generally from $1 to $1 to $1.75 credit on each side. You can use other credits if you want, but the higher the credit, the larger the drawdowns that I've found in my experience. And then I use from 50 wide to anywhere from 50 to 60 wide on average to all the way up to 100 wide because I want to pay as little as possible for that long leg. You can use any width of spread that works for you. Back test it to make sure it's going to work the way you think it's going to work. Then I set a stop for a 1x net loss, which is 2 times the initial credit. And I set that stop on each side separately. I don't set it on the whole iron condor. So management, I enter and manage each side separately, and I leave all trades on until either they hit the stop or expire worthless. And because MEIC has a clear set of rules, it can be easily automated. So I use Trade Automation Toolbox and Trade Steward for automation, and those work with multiple brokers. There are other automated traders available that work just as well. So, but those are 2 good ones that I know of. So here's a risk graph of an iron condor. So you're selling a put spread on one side and a call spread on the other. You make a profit if it stays in, the price stays in between those 2 prices that you sold, those 2 legs that you sold. And if it goes beyond that, then you're going to start losing money. And I set a 1x stop on each side. So if I collect 150 on one side, my stop is set at 150. So I'd never take full loss. That would only be in the case of like a nuclear disaster and the market shut down and I can't get out of my trade. That could happen, and that's how much I would lose. But most of the time, my daily risk is how much I've risked on each side times the number of contracts times the number of trades. So my risk in the trade is set by my credit, and then the buying power that's required is set by the total maximum credit on each side, or the difference between the short leg and the long leg. And so that's the buying power your broker is going to hold for the trade. Now, I also trade a slight, that is MEIC. And I did not develop MEIC. There were several people that worked on that, and I just have taken that. It's a very good trade. I put my own spin on it with MEIC plus. So roughly 30% of days that I trade end up at break even. So I set up the MEIC rules to take advantage of this. I set a stop for 10 cents less than a 1x net stop. So if my stop is if my credit is $1, my stop would have been $2 for a 1x net stop. I set the stop for 190, 10 cents less. And I use those rules so that if I'm stopped out on one side, I make money on the other side, my loss is a little smaller than what I made on the other side, and I make a little money on every trade that is break even. So otherwise, those would be break even, and I wouldn't make anything on those trades. So I do this, and like example, yesterday and today, I made money, even though yesterday I got stopped out of every call, and today I got stopped out of every put. It should say puts today. Today was puts. And I do aim for similar credits on both sides. This isn't critical, but it can help. And you can't control that in automated trading, but it is helpful. And the how much do I like? How much do you risk? Risk is very important. I think it's always good to keep in mind how much are you risking, and I risk no more than 2% of my account each trading day. So I add up all the iron condors I'm trading or all the sides I'm trading. If I got stopped out of every trade I entered, that is not going to be as much as a 2% loss in my account. So I can live to trade another day. And then, of course, I do follow the tasty trade rule of never risking more than 50% of your buying power each trading day. So that's the total risk based on the width of your spread less the initial credit. And then what can you expect with this strategy? Here is a back test based on BYOB that I ran for 2020 January 2023 through September 5th, 25 Friday, 2025. And it shows a compound annual return of 33.3% average each year. The max drawdown is 7.41, and that occurred in this period. That is, looks like around November, December last year through March of this year. Calmar is 4.5. Calmar is just a rank of the profitability divided by the drawdowns, and gives you a ratio that you can use to compare strategies. Now, in my live trading, I'm achieving a little bit less than that. So you can see I've got an average of 20.7. In 2023 and 2024, I was around very close to 30% return each year. But 2025 has been flatter, and there are certain reasons for that. Note my max drawdown is 4.3%, so about half of what the back tests show. And this was during the election, so I took a hit, and I really scaled way back during that time, and then I've been scaling up and getting back to normal trading lately. My Calmar is a little higher than that back test at 4.86 because of the low drawdown. So here it shows you each individual trade and what happened. And some trades I make 2%. If all the trades end up positive on that day, I make 2%. If all the trades end up negative on that day, I'll lose 2%. And and then a lot of days end up somewhere between 0 and 1%, either up or down, with more trades ending positive than negative, resulting in a good positive strategy. And that says there's 15,000 trades total in this 2.5 or 2 3/4 year period. Another bit of advice is just pay attention to slippage. That can make a big difference in profitability. And I've worked really hard. That what happened in October, just some glitches in slippage between various brokers became very evident during this time. And so we did a lot of work, me and others. We talked to CBOE, we talked to brokers, we tried to figure out why is it so different from one broker to another. And how brokers handle the stop orders is what makes the difference. Brokers who hold a stop at the brokerage will have the highest slippage. Brokers who send the stop orders to the exchange to hold until triggered will have the lowest slippage. Now, CBOE only accepts orders on single legs, so you can't send an order for a stop on a spread to CBOE. Your broker will have to hold that. And so to get the lowest slippage, use market stops on single legs held at the exchange. So you'll have to check with your broker. And here's a slide. You might want to make a screenshot of this. This is in one of my videos on YouTube too, so you can get it there as well. But this is the difference between a high-cost broker like IBKR and Tasty Trade and a low-cost broker like Tradier, E-Trade, or even TradeStation if you get some benefits with TAT. And then the difference, like what impact high slippage can have. And this is just trading one contract of MEIC with an average, say half of the stops stop out, half of the trades stop out. So that's the impact on your account that year. High slippage, you're going to end up generally, stops that are held at the broker and certain brokerages end up with high slippage. You can see here where those stops are held. If it's held at the broker, you're going to end up at the high end of this chart. If it's held at the exchange, you're going to end up toward the low end of this chart. So just something to be aware of for you zero DTE traders. And sources for other info is on YouTube. I have several videos. You just search for my name on YouTube and those will come up. And I don't hold anything back. So you get all the information that I have and that I know at the time. And I don't post videos very often, every maybe 6 months or so. But when I post something, it's usually got a lot of good information in there, a lot of updated information. And then I have some Discord groups, and you can send me an email. So there was my email up there. That I welcome questions and emails.
Thank you very much, Tammy.
I went pretty long, didn't I? Sorry.
Well, 8 minutes is not 8 minutes, right?
That's right.
we put up in the meantime a new live poll, and if you haven't responded, because it's good to know who is watching, what type of experience do you have, and you still have a chance to respond there. What is your experience with zero DTE trading? And I think we will bring in the results here as well now. Let's see how this looks. So this is pretty even, huh?
Yeah, a lot of intermediates now. Yeah.
Most people saying they are an intermediate zero DTE trader. What's your reflections, Dale?
Yeah, is it my turn?
It is your turn.
Okay.
It is your turn. So we'll just, but I thought we will just look very quickly at the result. What's your, what are your reflections about the
reflections on
level that people are saying they have?
Yeah, I think looks like half the class is about intermediate, which I would probably expect, given the topics of this strategy. I don't think when you hear zero DTE, you're probably not a beginner if you even know what zero DTE is.
That's true. Okay, it is your turn, Dale, to present your Iron Fly strategy.
Okay.
It's a quite exciting strategy, I think.
Yeah, as I click on my slides here.
And I will bring them in for you. Here they are.
Great. Yeah, so let me start first. I'll start my timer. I used to do stand-up, so I know when you got 4 minutes, they'll cut your mic off at 7. So I'm going to assume that that's the case here, John. So I'll start off with what is an iron fly? Well,
I have this signal.
Got my signal, the hook. So. And that I think that used up half my time just to echo there. So an iron fly is a 4-legged trade. It's got one short put at the money, one short call at the money. It's got both long puts and long calls as wings. And the reason I have wings, have you ever tried to trade SPX naked? Unless you're Warren Buffett, you just won't have the buying power. So there's lower buying power and it's got greater capital efficiency to trade with wings. So John, you could go with the next one. And so if you need to kind of take a look at what it looks like, this is essentially kind of visualized what an iron fly might look like. So questions I get most often, and I've organized this presentation of the questions I get most often. So how wide are your wings? And really every day they're 50 wide, beginning of the day around 7:10 a.m. Central Time. They're 20 wide towards the end of the day. What's the end of the day? Probably in the last hour to an hour and a half. Wings define the max loss and help control buying power. And in one account, I recycled the wings, which means I reuse them with other shorts. I look for wings around 40 cents in value, never wider than 50 wide. So you might ask, well, how's your performance? This is the performance over the last 27 months. And it's trading in all of my accounts. So, when I started, I was trading 4 accounts, probably, around $450,000 in buying power across those 4 accounts. I've reinvested the proceeds. With those 4 accounts, I was trading approximately 7 contracts in the beginning, and now I'm north of 20 in terms of trading, in terms of performance. Now, if you only traded one contract, which a lot of people ask that question, how would I do if I just traded one contract? And this is across since 2023. So I believe we started in April 2023. So you can see, some drawdowns here along the way. There is some guy that's automated my trade in what's this guy's name? Option Kurt Duplessis has
Option Alpha.
Option Alpha. Yeah, there's some guy that's automated it, and he calls it the not for faint of heart trade, which I think is comes off of your podcast, John. Because I said this is not your grandmother's mutual fund, so you can see some pretty significant drawdowns at time. I think when I presented to the option trading group in Dallas, when I talked about my drawdowns, I remember Tammy. I said, well, this is not the only option I trade. And Tammy said, well, do you have any other of the things you do that you could tell us about? Because kind of sometimes the drawdowns look scary. How would you do if you only traded one contract? Here's the range of earnings per contract in 2023. It was a partial year. There's one other person in our group, shout out to Sandra Galaska, who's been with me since the beginning trading this. And we've done from 29.5 to 31.5 per contract in 2023, 56 to 70,000 per contract in 2024, and 47 to 38,000 so far in 2025. So we're on track to potentially beat our 2024 record. So what are the growth mechanics? For every 20,000 in capital that is earned from flies, I add a contract. For every 20,000 in capital that I lose due to flies, I go down a contract. Now, that's less growth kind of aggressiveness than when I started. When I started, for every week I had a winning week, I'd go up a contract. For every week I had a losing week, I'd go down a contract. But you live by the sword and die by the sword, and that was pretty aggressive. So what's our process? So if you were filling up a glass of water, where would you start with the pitcher? You'd start in the center of the glass. And imagine if that pitcher is moving left to right and you get close to the edge of that glass, what would you do? Well, you could add a second glass. And therefore, now your profit zone is from the edge of one of the glasses to the edge of the second glass. So that's essentially kind of what we're doing is we're adding flies along the way. We have very specific rules for adding flies and for taking them off. Here's my performance statistics over the last 27 months across multiple accounts. And I think there's something at the bottom of that slide, John, that is kind of hidden by this new live poll thing. But it says the daily net income per contract is somewhere between 141 and 147. Daily net income per contract in the 2 accounts that have been around the longest. What else are you working on? I'm soliciting interest in an Ironfly hedge fund for accredited investors. We're building, Mike Carmendro and I are building an AI connected tool to better measure performance and offer strategy suggestions. And how can you learn more? Well, there's daily Zoom calls during the trading day, or you could feel free to join us on the Trade Diff Discord. So there you go. I have 26 seconds to spare. Thanks, John.
Fantastic.
Good job, Dale.
Thank you very much. And we have a new live poll out that many of you already have responded to. We'd like to know what type of zero DTE strategies are you trading? And here you can, of course, as well different multiple strategies. I guess not everyone is sticking to only one. So let's take a look at what you guys are saying here. Here we are. Mark, do you want to comment on what you see here?
Yeah, I'd say that makes sense to me. Most people are kind of delta neutral, but in general, no matter what you're trading, it's just a combination of puts and calls. So don't let the names intimidate you. And we're all trading the same thing. There's only one option contract out there.
All right. It's good to see. It was not surprising to me either that iron condors are on the top. Let's move on to you, Mark.
Yeah. So I won't be a full 8 minutes, and I don't have a presentation, but just in general, for background, what I do is I'd like to say, I'm pro tail trading, which is trying to just get a little more in depth about what we can trade. I trade a large ensemble of stuff. So I trade MEIC like Tammy, I trade Ironflies like Dale. However, I just combine all of those, and I'm much more concerned with basically the portfolio construction. I have no mental riffs about winning days, losing days, whatever. I'm solely interested in just maximizing the daily expected return and risk adjusted return while keeping the standard deviation of returns as small as possible. I trade a lot of long volatility. I trade a lot of large stop trades. I trade a lot of trend. I trade a lot of low stop trades that have no direction like condors, like everyone out there. However, it's just how I combine them. And basically the difference between me and everything that you're trading is I just have some back-end software that keeps me out of, the 10% worst of entries basically. So that's my main riff of what I'm doing. I'm happy to answer questions more in depth about it if you guys have specifics, but presenting what I was doing would be kind of difficult to portray.
That was a very short presentation. Very good.
But he did smile. We got him to smile.
We did. There was someone asking for that in the live chat.
Tammy will take the rest of Mark's time.
Yeah. No.
All right, we have a new live poll out there. Which broker do you use? This we are curious about as well. So it would be great if as many of you as possible can respond to this. And I will, we have a lot of people who have given their responses already, so I will bring in the results. Let's see, here we go. Tammy, you are using several brokers yourself, I know. So what is your comment on this? What people are using here? Are you surprised?
Well, I'm a little surprised. It's Thinkorswim is a great software, so it's good to see a lot of people using that. And then a smattering of other brokers kind of makes sense. With my chart of the lowest cost brokers, Tradier, E-Trade, and Thinkorswim are all pretty low cost. Tastytrade and IBKR are the highest cost brokers. So that's interesting that people are using higher cost brokers.
All right. So that's it for those polls. And I think we are getting ready to move over to the Q&A part. And let's just look for the questions here. Just one moment. And remember that you can vote questions up and down. And I see we have a full 50 questions in line here, so we should have enough to look at. And the first one is from sorry, I just need to do a small thing here to stop that one. And now we should hide the results and get to the questions. And the first question is from Sandra Galaska. When, and I guess that's for all, when would you consider the edge is gone and no longer run a strategy? What do you guys say about that?
I think it would, what I do is just monitor how I'm doing based on, compared to long-term averages. And if all of a sudden my win rate started going way down or my gains started going way down, I would probably, I mean, one thing I do is I lose on trades is I'll reduce the number of contracts I'm trading. And so I'm kind of naturally starting to trade smaller, but I'll start evaluating what's going on, what's causing this. And I have stopped some strategies on 0 DTE. I used to trade selling options in the morning, right at the market open because of the higher volatility. But around 2022, that stopped working very well. I mean, there were a couple of months where I don't think I had a winning trade in 2 months. So things definitely changed. And so I just monitor it compared to backtest and historical data.
Yeah. Kind of on that note, like how I would go about doing it is, first off, you need to look at the test. So like if you have multiple filters on it, or you're excluding any types of days already, that's already a massive red flag. And the real question is, it probably never worked in the first place. So there wasn't an edge and you're just made it up. Like the joke I like to say is, if Option Omega had a filter for how many babies were born each day of the week, you could probably find some great alpha based on, you know, the amount of babies that are born on certain days of the week. But being more pragmatic, assuming you have a strategy like Tammy that's executing the same thing each and every day with the exact same mechanics, not filtering out anything, the first thing I would basically do is I would look at, okay, is it matching my back test so the assumptions are correct? Like Tammy talked earlier, was it slippage? What is forever? And then the next thing I would do is I would basically run like a 2-year walk forward analysis with 3 to 6 months out of sample. So basically what that looks like is, let's say you're like, you are not including any data for the past 6 months because you would have tested it for a long period of time ahead of time. And basically you could do it every month or every 3 months. You move that 2-year period forward so that prior 6 months is always excluded. So like we need to give time for these things to work out, like sizing down. If you're size too large, you should always do that. But to actually have confidence that an edge or risk premium has degraded, we need to know the quality of what we're putting in first. Then we need to analyze it unbiasedly. That's not taking out any filters. That's then making sure our backtests match based on our commission cost and assumptions of execution. And then that's basically walking forward the data set. And the idea of walking that forward and keeping that prior period out of sample is our emotions are not going to get in the way of that prior 6-month period. And also by doing that, there should probably be a consistent pattern of where we see the degradation of this performance coming down. And we're also able to see that through a period of time while bringing that time forward. So every time we walk it, we're now including what is known, because we realize that the market can change and that risk premiums or edge can't come in and out of favor over time.
Good response, Mark.
I think for me, I tend to classify things into, is it my A game? Is it my B game? Is it my C game? Is it my D game? And along the way, if anything in my and I'm always paying attention to the percent of the contribution that they contribute to my overall return. And if anything that's in my C or D game, something happens, like just hypothetically, the CBOE hits you in the nose or something, maybe I might decide not to trade it for a while.
All right, let's take a question from C. Kai. I hope I pronounce your name correctly. How do we trade adjust 0DTE with VIX? So VIX is low right now. Which strategies will yield better results? How will we adjust this as the VIX continue to rise and fall? Anyone, any takers for this one?
I'll take this. So VIX has no effect on your P&L, and options are always priced the same no matter what. I think that the problem we have with the VIX is you're using a 30-day slice of volatility in the S&P to decide if your trade's going to work in the last hour of the day. That's clearly not a good indicator to basically inform you if it's 0DT trading. I think it's a completely random indicator, in my opinion. The other thing that I see a lot of people make mistakes with is if you use a defined VIX parameter of, let's say, we can't trade below a 15 VIX. So VIX changes throughout time based on different regimes. So a VIX of 15 was quite high in 2017, and you killed it trading 0DT options, even with lower everything. Whereas in the most recent regime of, let's call it SPX dailies 2022 till basically today, 15 was that lower bound of that volatility regime, which meant that we were kind of playing the price discovery around there before the VIX went back up. So there was a lot of chopping around and it tested very poorly. Those have no correlation or causation. The next thing I see people mess up with is they say, hey, Tammy's mechanics are $2 to trade MEIC. This is what I'm going to trade. So the at the money implied volatility is the most accurate price for volatility. And a lot of people may end up trading flies when they trade $2 MEICs. And when you do that, that implied volatility may be 15%. Whereas when you normally trade something, you're trading into the skew. Let's say in a VIX of 20, you're trading a 15 delta put that's at $2. And even though the implied volatility at the money was 20%, the one you're selling is 25%. So there's more risk premium or skew in that, and options decay faster when they're further out of the money and they have less gamma. So the nature, like you're already kind of gaming your mechanics when we're using a defined credit target. It's efficient. I do agree people do it. It defines their loss, but you're gaming when you do that. And that assumption breaks down when you start to go at the money because you have no skew in it. Now, I've tested this ad nauseum where you can scale SPX. I mean, you can scale your premium based on the price of SPX, and those ratios are linear over time. And the other way to think of it too is that when you're trading that $2 option contract and you're at the money in a low volatility, that position has significantly more delta risk to it, which then becomes gamma. And then the third order derivative, which is charm, which is the change of delta or gamma based on the change of the price. So you're taking a actual different position in those different volatility environments. So you just need to understand that that is a drag on your P&L. And the other thing too is there's no great answer, because in low vol, let's say we force ourselves to go 5 cents away. So instead of collecting $2, you're now collecting $1. Well, you're always going to have to cross that bid-ask spread, which is going to cost you basically 5 cents. So you're paying twice as much in slippage to get into the trade. And then the cost of your fees and commissions, instead of being 1%, now just went up to 2%. So your executional cost also go up. But in terms of volatility being priced the same or differently, it does not change. However, there is an effect on our P&L, and there are ways to mitigate that, but there's no real reason to not trade, in my opinion.
I did a study a few months ago looking at the win rate in various VIX levels, and it's just random. You don't win more in high volatility environments or lose more in low or vice versa. It is just random. So I tend to ignore VIX for my trading. And I see people commenting sometimes, not in these comments, but I hear people commenting that, ooh, the VIX is so low right now, I can't get any good premium. You can, it's the options are always accurately priced, as Mark said. Mark did a great job of explaining that. And so it really, I think people sometimes will talk themselves out of entering based on some filter like VIX, and when it would be a perfectly good trade. So I haven't noticed that it has an impact.
I would say for me, when VIX is very high, it's similar to the Chinese word for crisis, which is a symbol that means danger and opportunity. We've had some of our biggest wins on very high VIX days. We've also had some of our biggest losses on very high VIX days. So it's that balance. So if you can't stand the heat, you get out of the kitchen. But I do think it's a chance for a big win, a chance for potentially a big loss. We've had with small VIX, smaller wins, but also smaller losses.
All right, we have one person who has showed up in the studio, and that is Sandra Galaska.
Oh, applause. Cue applause.
Oh,
Hi, Sandra.
Where are you calling in from, Sandra?
I'm calling in from Tennessee. Yeah.
All right,
So,
very good. And we
yeah.
did actually do one question from you already about the edge. So I guess you have a different question for us.
Yeah. So first of all, thank you all. I think you all are amazing for all that you do and continue to do for the trading community. You've helped so many people, all of you. I know you guys talked a little bit about mental mindset. I want a little bit more about that, how you deal with especially Dale, with the extremes of big wins and big losses. And another question for Dale is, how do you trade in a daily Zoom room? How does the people that are in there follow along with you as you do these trades?
Okay. Well, first, in terms of mindset, so that was the first question. Like, how do you deal with large losses? I think there's an element in terms of mindset around optimism. How do you pick yourself back up? I think when something bad happens to you, it's temporary, it's specific, and it's changeable. You can tell yourself certain things like, "This too shall pass." It's always darkest before the dawn. Or one of the things I like to do every day is I write down 3 things. It's be smart, relax. Why? Because I find I make better decisions if I'm relaxed and I'm not all tensed up. And the third one is to be grateful. So no matter how small the win, as somebody told me one time, jelly's jelly, just put it on your toast.
Yeah.
So I think there's certain books that I would highly recommend. One of them is not a trading book, but it's a book called Learned Optimism. It's kind of how you explain the causes of the good things and the bad things that can happen to you. And I think that can help any trader around personal resiliency. So there's my short answer. Now, what was the second part of your question, Sandra?
Oh, it was people ask, how do they follow along with you in your Zoom room?
Yeah. Well, there's an entire process that we have for that to try to eliminate spammers. We try to protect people from those guys. And so there's a process, and registering with Zoom, coming onto the Discord, using your first and last name. There's a Google sheet that you have to fill out in order for us to get to know you a little bit better, and then registering for the Zoom call. I think some of those things will kind of help to make it safer. And the name of the Discord is Trade Diff.
All right, great.
I'll comment on your question, Sandra. The mental, how do I handle wins and losses, is basically I try not to look at them as wins and losses. I look at them as, did I follow the rules or not? And I've back tested enough so that I know if I follow those rules, I will get a certain result after a certain number of trades. And that does involve some wins and some losses. So if I have a loss that day, it's just, it's a part of the probabilities of trading options. So I'll leave it at that. So we can move along.
Thank you very much. Good answer to you, Sandra, and thank you for connecting in here.
Yeah, thanks.
Thanks.
And we need to move on. We have actually 56 questions, so I guess we need to speed up a bit. But I will tell that those who actually do like Sandra and join in the studio for asking the question on video, you are actually skipping the line, even if you have not been as upvoted. So that's just my little trick for you. You go to this link that you see on the screen right now. But now we have a question from Mark McNair. Would love to hear each guest's thoughts on hedging strategies that cause the least amount of bleed on a portfolio. What say we to that?
I would say the first one is just sizing, because if you size at a reasonable size, you're never going to pay volatility drag. So 25% drawdown, you need 8% gain to get back to even. That could throw it away. The next thing I would say is like using, the world's orthogonal, which basically means like uncorrelated. But I think what a lot of people miss with that is, if you do MEIC every hour, you are relatively correlated, but sometimes it can hit you. Like I say, a good rule of thumb is your trades, if they have the same mechanics, are about as correlated as the time they're exposed. So if you have a trade on 10, you have a trade on 11, they're exposed for 80% of the same hours, they should be relatively correlated with that. But when you start mixing in a trade that has a 3x stop and starts at the beginning of the day versus 1x stops at the end of the day, and then you have something that's buying an option instead of selling an option, it's a much easier way to go about hedging when you mix in a calendar, something overnight, a long volatility strategy, and you just try to maximize the profits of all of those and don't really focus on how they offset each other that much, and then just work on the size, and that'll naturally kind of make a hedge, similar to how Tammy does MEIC and METF. They're both profitable strategies, and she just kind of sizes them in a way that they can help her make money each day. So that's a form of hedging that you back into. Whereas if you think I put risk on, how do I offset this risk? You have to understand that if you were to do that perfectly, there'd be a 1-to-1 ratio. So like a perfect hedge, there's no possibility of making money, which is what you don't want to do. And whenever you introduce that hedge, you're going to realize what's called idiosyncratic risk, or risk that is unknown. So if something is 0.8% correlated, that means 20% of the time, the movements are unexplained by one another. So that's generally how people will do a hedge when they sell an option and they buy an option. But if we do that with just multiple different strategies, and you have one that's 0.2 correlated, one that's 0.8 correlated, those will naturally just use that idiosyncratic risk in the same way, but they're all profit centers for you. So that's like the simplest back of the napkin way I would recommend doing it. And you can kind of benchmark that to adding these in. How does it affect my portfolio? How does it decrease my standard deviation day to day? How does it change the next drawdown?
Good answer.
One of the things I like to do is I like positive theta. And if I can find a hedge that gives me positive theta. So for that reason, I like poor man's covered puts on things that I'm bearish on to offset some of the positive delta, beta weighted deltas from my poor man covered calls.
And I try to avoid hedges just by sizing, like Mark said. That's the best hedge you can use. So hedges always come with a cost, so I avoid that extra cost.
All right, let's get to the next question, and that is from Omid. What is your experience in using gamma, put wall, call wall, and other data that shows market makers hedging moves to trade 0DTE SPX options? If you are using these data, which vendor do you prefer and why? And before you answer, I do recommend everyone to be active in voting up the questions, since we will not reach everyone, so we know which one most of you would like to hear. So who would like to answer this one?
I got a short one. I've still yet to see anyone that's proved this is actionable with any kind of data. And like what a lot of people also don't know is like you could see a bunch of like a massive put strike volume in the S&P, and simultaneously large institutions could be short the VIX. So they're not actually long that option, and you have no idea what that full picture is of it. And what I always see is like the spot gamma guy, he releases a video the following day and he's like, as you can see with the hero indicator, it came up through here. That's a good amount of volume. And the other thing is it's like he makes up numbers of what the volume is or gamma or whatever. And it's like, well, depending on how many people are trading, is a billion a lot? Is a billion not? Like if there was an announcement, of course, there's going to be more volume. So like I said, I mean, I've looked at it. I've been open to it, vol land, all that stuff. All your trading gurus have never seen anything actionable. And also the P&L is good from just being mechanical. So like, why change it?
I can't answer any better than that. I don't use any indicators, so
I would say what Mark said. There are people in our group that use it, that comment on it. I listen to everything, but I haven't found any. I think all of it together gives me maybe 2% edge.
Here is a question from Wei. What are the most useful technical indicators for strategies such as credit spreads and iron condors, both for entry time and price selection? I guess you, Tammy, said that you were not using indicators.
I don't use indicators. I've found that they tend to keep people out of trades rather than get them in the best trades. So they don't do better than just the straight probabilities of the options. And I've tried a lot of indicators, I'll tell you. So we went down a rabbit hole for a couple of years with Pong, trying to find the indicators that worked, and it just never worked better than just the probabilities of the options.
I think for me, I like stochastics. I like to use Laguerre RSI, those two. I don't really use them around 0DTE as much. I used to, and now I use them more around scalping futures.
Yeah. What I've seen from it is like for buy and hold, if you're using like a momentum, it actually is quite promising and keeps you out of like drawdowns and such in the market. However, with options, all that information is already kind of priced in with the price. So all retrades, it's like, I do think they work, but what you need to understand with indicators is it's like you're now excluding data. So I'm going to have less confidence in the data of that data because it can deviate in the future. And then since inherently how a lot of us trade with stop losses, we already are managing the risk well, that like you've just decreased the amount of premium that you're now selling. So like you have less confident data and you're selling significantly less premium. So now you're just taking maybe 4% risk on that day, and obviously anything could still happen. So like what I've seen is you can get basically the same results, maybe better for a little bit, and it just ends up like wavering into longer hot streaks and worse drawdowns when that ends up having to change. And the other thing I'll say with that too is it's like, I know a lot of people like trading bigger on Fridays, and we've all done the back test, like, woo, Fridays test the best. But like every day of the week has positive expected value, and not trading has no positive expected value. So it doesn't really make sense to size them on Friday. And it also doesn't really make sense to size a day, even though empirically I'm with you, woohoo, Fridays work better. But this comes back to like the banking system. Like the whole theory of the banking is like, if they can loan out a good enough loan that fits the risk parameters, they just want to move the velocity of that money as fast as possible, because that will compound over time. Like I started, trading with an audited record about 2 years ago. And it's like last month I did 2%, but the people that came in, or, the original balance of the account from that first day 2 years ago, that was actually up 4% because I was taking the same risk and that was compounding. And that is the ultimate indicator that you can make 2% and actually return 4%, not that something happened on Friday and the VIX went down and it's 230 and I'm going to put 4% of my account in, because it will bite you. I don't know how long it would take, but it will bite you. So in general, I don't really like them very much for options. I do have some proprietary ones I've been working on for a while, but like I said, our goal with that is not to find the best time to trade, but rather exclude the 10 worst percent of times to trade, which is obviously a much easier problem to solve than finding the best 10% and much less likely to be curve fit.
We got a question for you, Tammy. Can the MEIC plus strategy also be automated in Trade Automation Toolbox?
Yes, it can. I've recently done that and pretty successfully. What I do is set up a separate template for puts and calls. So rather than entering a template as an IC or on Condor, I do separate templates for the puts and calls. And I set in the scheduling, I set up a target. I think it's called for under quantity instead of a number of contracts. I set up a premium target. So that or premium allocation, I think it's called. So that let's say I want to risk $300 in each trade, and I can calculate that based on is that within the 2% risk that I want to take on max per day. I calculate what that value is, and then regardless of the credit, TAT will figure out how many contracts it could trade and not go over that amount. And so, if you get 75% credit on one side and $1.50 on the other, it'll enter 2 contracts on one side and 1 on the other. So yes, you can automate that. I've found it's automated easier in TAT than Trade Steward, but I've been talking to the people at Trade Steward about adding that feature. They just don't have it yet. But all of these backtests, all of these automation software, they're all very open to suggestions, and so that should be coming along in Trade Steward soon.
We got a question that I guess is for Dale and Tammy. Could one combine Dale's in Ironflies and Tammy's MEIC? I always stumble on that abbreviation in one account, or would the strikes interfere? What say you, Dale?
I do think there's some challenges because if you sometimes a particular strike may be taken up by something else. So you always kind of need to keep that in mind. The analogy I think of is as you're playing chess, you kind of if part of your strategy is to keep a certain spot vacant, you kind of have to plan for it. So I wouldn't say it's impossible, but it requires more planning on your part so that you don't end up taking up a trade on one thing. And then you're using a wing that's closing a trade in another thing. It can become quite messy.
I'd say that as long as you're paying attention, you're not trying to sell an option that you already own or buy an option that you've already sold, you're safe. You could double up on selling options, but then for the longs, just move the long out a strike if you end up with a conflict. And but yeah, you probably could end up with some conflicts trading flies and condors at the same time.
Especially if you're trading multiple accounts. If you're focused on one,
yeah.
if you're focused on one account, you can handle it. If you're trading like multiple accounts, it might present a problem.
We have a question for Mark. If the market drops 5% or more suddenly due to some event, how do you tackle the capital and what is expected then?
I'm not sure if I know 100% what you mean. How do you tackle the capital? I guess that means like loss. But if the market drops 5%, like I already have a stop loss in, so like I'm already ahead of everyone else who is trying to get out after the fact, and I just size appropriately. Like I know some people are gonna kind of freaked out about this, but it's like the fact that the market can just randomly drop 5% and would potentially wipe out 15, 20, 30% of your count is also an extremely strong proxy to like why all of this works. So like I think people should kind of find solace in that as well. But in addition to that, we are trading the most liquid option instrument on earth that is regulated by all these rules. And we also have our order in before the event happened. So even these like high frequency algos or whatever, it's like they're potentially a little behind us. So I would just say size appropriately, Also, since you're closing out your short leg before your long leg, like Tammy talked about managing it, most likely you're probably going to be good. Like my experience from all these large moves is like I end up eating a large amount of slippage 2 to 3 times, maybe the entire premium I collected. But then my long wing ends up going in the money and I make a 5,000% return. So those are, I want more of them. Those are my best performing days I've ever had, actually.
Yeah.
And while we're on you, I will give you 30 seconds to answer another question. Mark has said that stop loss is the first line of defense. Can you get more detailed about buying longs for protection? How far out in time, and do you go by delta or price when you buy? Do you let them expire or roll at a certain point?
Yeah. So like I would say that a stop loss is what your risk is in theory. Like you're going to get filled at it. That's what we think. But our risk in practice is actually the basically width of our spread or our buying power. So like the easiest way I would recommend people for doing this is like if you're trading a 1x stop trade, it gets stopped out roughly 45% of the time. So don't buy back your long leg. So like if you have 2 trades on and then you get stopped out on one of them, you now have 1 extra long leg and 2 short. So if it were to just gap down really aggressively, like at a certain point when it would get catastrophic, you're now long the market on that account because you have an extra contract. So like that's the simplest way to do it. The other way, like I talked earlier with the money implied volatility and out of the money implied volatility, think of it as like a relative value type thing. If you buy an at the money straddle, the implied volatility is 15%. If you're selling it out of the money, you put the implied volatility is probably 19%. You need to be careful in sizing and make sure you got everything correct like that. And then if you buy something that's longer out in duration than what you sold is going to decay faster than, that long that you bought. It's very hard for people to do that in SPX unless you have a large account. So again, I just kind of recommend people don't do that in general. And then the other thing for a proxy too is it's like when you like lose on a side, you're already kind of trend following. You're just not necessarily doing it with a long option because you're lifting that side because you think the trend's going to continue to go. So people are kind of naturally doing it. I wouldn't it. I would say own some long equities just, for diversification and just basically cash or short-term bonds. And that will be more than applicable to hedge those drawdowns because you sized appropriately.
And we have a question for the Ironfly guy, a man with nerves of steel. Dale, on your performance chart, you went from a cumulative performance of 2 million to a cumulative performance of 1 million. How did you cope with this mentally? Well, I'm curious about.
You keep asking yourself, has something fundamentally changed? And if it hasn't, then you put one foot in front of the other. And, they say when you're going through hell, keep moving. And that assumes that your strategy's not bad. And if you've back tested your strategy, if you've tested it over some period of time, I tend to be committed to a strategy longer than probably most people. But it takes me a long time before I pull the plug on something and give up on it. But there is significant sequence risk, which basically means when you got in at some time, if you got in when we were hitting that peak and you had this huge loss, it's very few people that can sustain that level of pain. But if you've sustained a significant amount of gain up to that point, you've got enough deposits into the emotional bank account that you could afford a withdrawal. And I guess that's so I don't think it's never easy. There are times where you second guess yourself. You just got to make a determination. And if the determination is it's still a good strategy, then you get out of bed and you put one foot in front of the other. And I think if I have one strength, it's putting one foot in front of the other and doing the same. Some days it feels like Groundhog Day. So it's like every day's the same, but I don't mind that. I enjoy it a lot, enjoy the activity itself.
That's good life advice, I think. We have one more question for you, Dale. How do you pick the wings for your flies? What
How do you-
determines when you stop out of a fly?
I think I covered that in one of the slides. At the beginning of the day, it's 50 wide wings. I typically reduce that width, finding the width of the wing that's closest to 40 cents. That's the magic number. And at the end of the day, I don't go more narrow than 20 wide. And the reason is if you start going 10 or 15 wide, you may find yourself creating a fly that was a wing for another fly, and you'll start running into wings and the short calls and puts that you're selling. So for that reason, I don't go more narrow than 20.
All right, let's take a question from Omid. Trading 0DTE SPX options is by itself an intensive subspecialty of options trading. Since your main focus is on 0DTE SPX options, do you also trade other underlyings with longer DT? If yes, what are your top 3 strategies? Will you take that one, Tammy?
Sure. I focus exclusively on 0DTE options in my options trading. I only trade a portion of my whole portfolio in options, and the rest is in more traditional investments, longer term investments, mutual funds, things like that. So I don't trade other strategies. I have in the past, and sometimes I will trade. I'm forgetting the name of the trade. That's the black swan hedge. Sometimes if volatility is really low and the market is really high, then it's a good time to start putting on that black swan hedge because it's cheap and it takes advantage of a good increase in VIX if you get it. So I did that last year. I think it was August 8th. Trading day where the market dropped a bunch. That was probably one of my better days, just because of the hedge that I had on. But usually I don't trade anything else because I don't like that overnight risk with longer dated options. So I would, if I traded something else, it'd probably be 0DTE options like Dale's flies or something like that.
Mark or Dale, any one of you are trading something
Yeah.
is not 0DT?
I really like dual momentum in equities. So I think that's really interesting. There's a bunch of books out there. Ron Bertino has a course. Gary Antonisi has a good book as well. So like I like that in terms of a buy and hold. I also do trade like some overnight stuff. The early retirement now guy kind of like selling stuff 1 DT, even out to 14 DT. Similar to Tammy's point, it's like it's just too much stress for kind of what it's worth. It does improve my return, but like it's kind of a way to just pick up like 5% return with a 5% potential drawdown, but it uses 5% of buying power. So, it kind of pencils out. But for the most part, like it's nice just going home at the end of the day. And then another thing I'm just really interested in, which I think a lot of people should, is just like what investments can effectively offset your taxable gains in trading. So like I look at a lot of real estate syndications, private equity, stuff like that, oil and gas exploration, all have really good tax write-offs to where you can invest 100 grand, you get 100 grand of depreciation, and you get like a 7-8% yield on it, which is really, really valuable, especially depending what state you're in, or like a mega backdoor Roth also is like really cool. So there's actually, I could send it to John, but there's this guy named like Ankar on LinkedIn. He was like an exited VC guy, and then now he blogs about like how he, basically is tax efficient, and he has like a bunch of guides and courses and stuff. So I think a lot of more people should. The easiest alpha to get once you already have your 0DT strategy is like relax more, and then like go collect 20% more of your 0DT profits by offsetting your taxes.
Mm-hmm.
For me, I like to trade poor man covered calls, as you're aware, John, since we did a prior podcast on that. It's probably 50% in my portfolio is around poor man's covered calls. And then I'll offset that with some bearish strategies around poor man covered puts, both of them spewing out positive theta. So I think, and then I'll trade a few strangles on commodities.
We have a simple question for everyone. What broker are you using? And Mr. or Mrs. Anonymous is saying, I'm getting killed on fees with Tasty Trade.
Well, I use Thinkorswim, part of Schwab, as well as Interactive Brokers.
And I use E-Trade for manual trading, Thinkorswim trading with Trade Steward as the automation, and Tradier with Trade Automation Toolbox as the automation.
Yeah, I use Interactive, TradeStation, Tradier, Toss, E-Trade, Webull. I've tried them all. What I will say is like the real key is they all have trade-offs. I do think just by and large, Tasty's the worst and makes no sense because they're just optimized for their you can close for free. So like their value prop for 0DT just makes zero sense. However, I think what a lot of people miss out with brokers is like they all have their trade-offs. So it's like Interactive by far has the most expensive commissions. TradeStation by far is the cheapest. However, if you have an account, I believe it's above 120 grand, Interactive pays you 4.75% in your account, and TradeStation pays you no interest on your account. So even if I pay 3 times the commissions Interactive brokers, do I really pay more in commissions because I get that interest? And this even kind of comes down to like the slippage concept, which I think a lot of people get wrong too. So Interactive brokers does not rest on exchange, and STD on TOS rests on exchange. So a lot of people say, hey, I get 5 cents slippage on TOS because that's what all these retail platforms will show. And you get 20 cents of slippage on Interactive brokers. But what actually really happened is your order got fired off on Interactive at 110% stop loss instead of 100% stop loss like it did on TOS. And even though you're taking 15 cents more slippage on Interactive brokers, you didn't like it only takes one trade where there's a $9 opportunity toss that got top ticked on TOS. It did not get top ticked in Interactive brokers to change that. And it's like I've traded the exact same portfolio on TOS where I average 4 cents slippage and I average 15 cents on Interactive brokers, and my premium capture is exactly the same. My win rate's higher on Interactive brokers than it is on TOS. So for a lot of people mentally, I get why you're on TOS and you do stuff like that. But I also think that we need to think about how each broker is optimized for certain things. So like, you know, TradeStation, if you're leveraging out the maximum amount of your account and you're not to 120 grand in Interactive where you collect interest, it's by far the best broker for you. Like portfolio margin kind of sucks on TOS. So that makes sense for you to be on Interactive brokers. So I think people need to understand what they're optimizing for. If you're rolling strangles and trading early and trading often, like Tasty Trade may work for you. But that's the real key where I think people need to look at their brokers, or frankly, if you just like Thinkorswim for the UI, just use Thinkorswim. Don't really compare them as much like this. And the other thing when we get back to the concept of slippage is it's like if TOS really had 5 cent slippage and Interactive brokers really had 15, then why would you just not arbitrage across the brokers? Like where you buy on one and sell on the other, and you should essentially be able to market make continuously. You're just having different optimizations for what you're doing and what you're telling the broker to do to how to behave. So just make sure those are congruent.
We are starting to run out of time, but we will do a couple of more questions before we sum up. And we have one from also Mrs. Anonymous. How do you handle the big swings in PL, profit and loss? Does a big winning or losing day impact you? What about you, Tammy? How much does it impact you when you have a bad day?
It's a bummer, but it's not going to ruin my day. It's just part of trading in my mind. And because I've sized my trades before I even enter the trades, I know that that's a possibility that I could have that size loss. So like I said, I tend to not look at wins or losses, whether I win or lost, won or lost that day. I look at, did I follow the rules that day? That's a lot harder to do than winning and losing. So for most people, it is very hard to do. So that's how I, and then if I had a big loss, if I had a 2% loss, I'd just go do something else. I'd, just go garden or something to get my mind off of it, and or go have drinks with Dale and commiserate. And so.
Well, I guess you already somehow answered it, Dale, but what about you, Mark?
Yeah, I would say like obviously everyone gets an emotional flush from when you lose. It gets a lot easier if you're like financially independent or if your size is a small percent of your P&L. But one thing I would encourage people to do is like it's similar to like when you work at a job. You like people kind of like to bond over having worked too much or that they want more money or whatever that is. And it's like when you behave with your mind and your body, like I literally used to have a phone call with this one guy like every time after we get a bad loss, and he was really like, kind of messed up for it because he had a lot riding on his trading more than me, and like groveling over that, it was productive for like one or two times when it's a bad day and you want someone to talk to, but like when that's your habit, you're like renormalizing and playing into this feedback loop that like the market makers got us, this is happening, low VIX is going down. And by you behaving that way, you're just making it harder for you to do it. It's similar to like, like I run a hedge fund and it does really well and it's monetarily lucrative. But like if I go on Instagram, for some reason, everyone selling courses is like way wealthier than me, which like can't be possible really. You know what I'm saying? And it's like, that's not good for your mental psyche. And like, you need to stand guard to the door to your mind. And similar to what Tammy and Dale talked about is it's like, if you just practice the act of being grateful or gardening and doing something else where your entire life is not revolved around trading and you bonding with other people because you don't have as much social interaction over losing and trading, like that's how you're going to feel. So I would say like outside of trading, really try to cultivate habits of like your health is the most important thing, like your family is important, your trading P&L really doesn't mean anything in regards to the grand scheme of your life. And if it did, you'll probably have a higher quality of life not doing it. So it's like your underlying self as a person, it's what's going to determine how you handle losses in trading. And it's like an exercise in honesty. Like personally, I don't enjoy them, but losses and drawdowns make my trading better significantly because it gets me curious about what's happened and I get a real-time diagnosis of what's going on. So like losses make me more money than they ever have before, and they continue to make me more money than they ever have before. And like even comparing this low VIX or lower bound of VIX, like from this year to last year, mounds of improvement. So that's kind of the perspective and thought process that I would just encourage people to take a belief and just be curious of how you're using your physiology and acting.
As a poker player, John, it's people like to walk around and tell bad beat stories. A bad beat story is, let me tell you how unlucky I got over at this last table. And the truth of the matter is, no poker player likes to sit there and listen to your bad beat story. So I always say, well, it could be worse. And they say, how's that? And I say, you could be listening to this bad beat story. And, I think it's kind of the same way if all we're ever doing is kind of whining about something. It's like a kid riding a bicycle. Don't hit the rock, don't hit the rock, don't hit the rock. And all they're doing is looking at the rock. Boom, you hit the rock. So I think we tend to remember longer the bad things that happen to us. But you got to offset that by being grateful and counting your blessings.
Let's close off with a quick question from Joel. What percentage of your overall investments is dedicated to zero DTE trading?
Well, it kind of depends on how you measure it. I think if I look at it in buying power, it's probably 10 to 25%.
And mine, of my whole portfolio, it's probably 30% of my whole portfolio. Buying power would be about 15%, I guess. Yeah.
I'm have been well over 100% of my net worth into it for like 3 years now. And it was stressful and did it. I was obviously in a different place in my life, kind of reached a area of critical mass to where I'm pulling it out now. But what I tell most people and recommend is like 25% in kind of like options or volatility, 25% in short-term bonds or a high yield savings account, 25% in equities, and then 25% in real estate or your primary residence. I think that's a very good rule of thumb. And I think 50% could potentially be appropriate if you were like very young, similar to what I was, or retirement funds are forced to be invested. You're not choosing between paying down your mortgage or going on a vacation with your family and investing your IRA funds. So like, I think you could go up to 50 as absolute max.
I think we will start to sum up a bit, but I have put out, open a new small little poll that is a bit similar to the one we started with. Which single word best describes your impression of today's Theta Live? Before you said what you would expect. Now we would like to know what you got out of this. But let's take a very quick summing up of what we have been through and the questions and so on. What would you say, Tammy?
I would say it's always interesting to talk about options. And I think I learned a lot from what other people are doing, Dale and Mark. And hopefully the viewers got something out of this and can see the differences between our strategies and the similarities in our strategies and learn something.
What about you, Mark?
Yeah, I mean, I always like kind of chatting with communities, and I think that it's good we did something like this because people that may have followed Tammy that don't follow Taylor or me can kind of be exposed to a different perspective, whereas we can often put someone up on the pedestal. And the other thing too is like there's only one movie going on where we are actually all trading the same thing in the same style, just like there's just different crossovers of those spheres when they come through. So like it's really not as intimidating as people think. The underlying part of it is it's basically risk premium. So like you have to control your risk so that you can continue to play. And that's really where people screw up.
Like that.
And while you sum up, Dale, I will also bring up the results from the live polling, and you can also comment on that if you want.
Yeah, I like that, Mark. Like staying in the game, live to fight another day. And you know, I think this forum comes as close as I've seen to kind of an online happy hour, where it's just a lively chat with a purpose.
That's very good. And we see here people have found it inspiring, awesome, informative. That's very good. I'd like to thank everyone who registered and who took part in this. And I do plan to organize another Theta Live on a different topics later in the fall, and will love to get your ideas and suggestions. So what I actually will do is that I will put up a new final poll where you can give your feedback. We are not going to show the results of that one, but it is the question: what are your ideas for how we can improve Theta Live? What would be good topics and guests? So put it up in the VBox app, and if you have the time to give some response there, some suggestions, it would be much appreciated. That's all for this event. Thank you to Tammy, thank you to Dale, thank you to Mark, thank you to everyone who have been watching. This was great, and I really appreciate all of you showing up. Thank you very much.
Thank you, John.
Thank you, John.
John.